Now we're diving more into that tax basis and at-risk basis, kind of a lot of what we talked about as well, but even more. Now, these are two concepts related to the amount of an investment that a taxpayer has in a business or property. Generally speaking, we're going to see this when it comes to partnerships. So, I mean, yes, we'll see it in other cases, but generally speaking, dealing with what's your tax basis in a partnership versus what's your at-risk basis in a partnership. This is also known as your cost basis, your tax basis right here. This is going to represent the original value of an asset for tax purposes, usually the purchase price. Now, again, this can also be a physical asset, like I bought a truck, right? Something like that. But we will see it mostly for partnerships. That's why I keep saying that. And that can be your purchase price into a partnership, right? You're buying into a partnership that is an asset, adjusted for additional investments, contributions, improvements, reductions such as depreciation, distributions such as partnership distributions, or any previous losses. A tax basis is going to be used to calculate the gain or loss when the asset is sold or disposed of, whether you're selling your PP&E or you're selling your partnership interest. A higher tax basis reduces the taxable gain or increases the deductible loss on the sale of an asset. And then we have our at-risk basis. Now, it's pretty much the same thing, but it's going to include that recourse debt, because this is going to refer to the amount of money that a taxpayer has at risk or stands to lose. And like I say, what's your skin in the game? In a specific investment or business activity, this is going to include a lot of the same things: the cash contributed, the adjusted basis of contributed property, and certain borrowed amounts in which you are personally liable, which, ding, 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 that is recourse liability. So we see where recourse liabilities play a role in our taxation. The at-risk tax basis, it's going to be used to determine the maximum amount of losses that a taxpayer can claim for tax purposes from a specific investment. Now, losses in excess of this at-risk amount are disallowed in the current year, and they're carried forward to future years when the taxpayer's at-risk basis increases. What's the whole point of this is the IRS doesn't want you taking these massive losses from a sort of, and again, I'll just say partnership, I'll keep using that example, when you didn't really have that much at risk to begin with. It's limiting you. We don't want you to be able to deduct $100,000 in losses when you only had, let's say, $1,000 to lose to begin with. That's kind of keeping people in check, not letting them manipulate the tax code. And even if they're not trying to manipulate the tax code, just stopping people again from taking these crazy amounts of losses when, to be fair, they didn't really have much invested in the first place. Do you like that or do you not? It's not for me to decide. You can go argue with the IRS. Moving on, the tax basis, nice little summary here, is the value of an asset used to calculate the gains or losses upon disposition. And again, this is normal. So if we think about a depreciation and then selling an asset, something like that, that's your tax basis. That is just your simple tax basis that you're using to depreciate. It's using what you are going to see when you're selling the asset. While your at-risk basis, this is going to represent the maximum amount of losses that a taxpayer can claim on their tax return for a specific investment or business activity. This will be covered much more in partnerships, but if you've got $10,000 of basis, let's say at-risk basis, and the partnership, your share of partnership losses are $20,000, well, you're going to be capped at your basis because the IRS doesn't want you taking the full $20,000 because that would be in excess of your basis. And you can't have negative basis. That's something we'll see later as well. The at-risk tax basis is a limitation that prevents taxpayers from claiming losses for which they do not have a genuine economic risk. It's something we're going to understand what we need to know for the exam, as well as kind of getting a general idea of how this all works. It'll help you out for sure. Examples, gotta love it. We are seeing visualizations because if I just lectured at you, you'd probably get bored and you wouldn't know how it works. So suppose John invests in a partnership by contributing $30,000 in cash and a piece of land with an adjusted tax basis of $20,000. Now, additionally, John secures a non-recourse loan of $50,000 on behalf of the partnership. The non-recourse loan means that John is not personally liable for the repayment. And again, just a reminder, please memorize the implications of recourse and non-recourse. The lender can only collect from the collateral, which is the partnership's assets, in the case of a default. Now we're going to calculate John's tax basis and his at-risk basis in the partnership. So John's tax basis includes his cash investment, the adjusted basis of the contributed land, and the non-recourse loan. This is something, again, we'll see with partnerships, is that any sort of share of loans gets added to your basis. So we've got $30,000 of cash plus the land contributed. And what are we using for land? We are using the adjusted basis. There's no fair market value here, but we wouldn't use fair market value. We always use adjusted basis. And then we're going to add in the non-recourse loan. So loans are added to your basis. It's kind of, again, like what's your skin in the game? we have an additional basis amount because when we wind down, when this partnership winds down, we have to pay this off. So this gets added to our basis. And again, if this isn't totally, clicking yet, it's because I'm also talking essentially about partnership concepts when we have 3 big, beautiful partnership lessons in the future. But this is why just a note here, it's great if you go through all the lessons, the whole course, and then you come back around and do it again. Because there's only so much we can do because a lot of these things are intertwined with each other. So you go through all the lessons, you come back through them again, you're like, oh, I didn't pick up on that the first time. Well, then you can do it on your second time around. Now your at-risk basis, that's going to include what are you personally liable to lose? Well, if everything goes under, if it tanks, if everything goes to hell, you're going to lose your cash and your land. But the partnership is liable. The entity is liable for the loan. John's not. So your at-risk basis is 50. So you see, in some cases, your at-risk basis can be higher than your tax, and in other cases, your tax basis can be higher. Just depends generally on your non-recourse versus your recourse loans. That's going to impact. Now, in this example, the tax basis in the partnership is 100, while the at-risk basis is 50. If the partnership incurs losses, John can only deduct losses up to his at-risk basis. So we see this is kind of like the first checkpoint. You cannot deduct more than your at-risk basis. Any losses in excess of his at-risk basis must be carried forward and can be deducted in future years when his at-risk basis increases. So again, these two have different meanings. These two have different implications. Tax basis is used for various things, such as what happens when you eventually sell your interest or you're winding down liquidation, whereas at-risk basis is used for determining your limitation on losses that you can recognize each year. That is important, and I'll beat that to death. I want to make sure you know that. We'll go through that again when we deal with S-Corps and partnerships, but if now is a good time to go through that and memorize that, I mean, for you personally, I would say go for it. A lot of this is important.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.